Welcome to Investing Insights. I'm your host, Ivana Hampton. Investing Insights is helping investors navigate market volatility in a new series. Morningstar strategists and authors will deliver timely insights, trends, and tips. These episodes will pop into your podcast feed at least once a month. This week's episode focuses on which investments might be safer than others during a recession. The chances of one happening have increased quite a bit over the past few weeks. That's according to Morningstar's U.S. economics team. Amy Arnott has researched past recessions to identify which asset classes, investment styles, and equity sectors fared best and worst. The Morningstar Inc. portfolio strategist discussed her findings to help investors limit some of the damage. Thanks for being here, Amy.
Sure. Thanks for having me.
Well, fears of a recession are growing because of the trade war uncertainty. How does this current volatility compare to other times? But before you answer, let's timestamp our conversation. Today is Wednesday, April 16th, just before 11 a.m.
Yeah. So, we saw market volatility starting to pick up around the end of February. And as you know, we had the big spike in early April, right after the more specifics on tariffs were announced. And we saw a big 2-day drop in the markets when, there was one day the market was down about 5%, then another 5% the next day. Since then, now that we're in this 90-day pause, things have settled down a little bit. But if you look at the VIX index, which is measuring market expectations for future volatility, it's still pretty far above average at this point. So, we're running about 30 or so with the VIX versus a long-term average of about 20. So definitely a period of heightened uncertainty and volatility.
Now, the recent up and down moves in the stock market have rattled investors. We're told not to look at our portfolios. Some of us did, Amy. What about you?
I had to look at my portfolio because I had to log in to make a transfer so that I could pay for my taxes. So, it's never fun to see the number going down. Fortunately, in my case, it wasn't too bad because I have a pretty well-diversified portfolio. But I think in cases like that, it's helpful to just take a step back and remind yourself, what am I investing for? What is my time horizon? Hopefully you have an asset allocation that makes sense for your time horizon and your goals. And if that's true, then I think you can just reassure yourself that volatility is temporary. We do have downturns in the market from time to time, but the long-term trend in the market has historically been positive.
Can you talk about how market volatility like this affects someone who's planning to retire within the next 5 or 10 years?
Well, if you're closer to the 10-year end of the range, it shouldn't be a major issue. But as you get closer to 5 years before retirement, that's what a lot of financial advisors will call, kind of the retirement danger zone for sequence of returns risk. And that's the issue where if you have a couple of down years in the market, there's less time for your portfolio to recover before you retire and start taking portfolio withdrawals. So if you are in that 5-year window before you plan to retire, that's why it's definitely a good idea to start de-risking your portfolio and make sure you have some exposure to safer assets like cash and bonds, especially short-term to intermediate-term bonds.
And what about current retirees?
Yeah, so kind of the same thing where if you're in the first 5 years of retirement, that's the period when you have to worry the most about the potential impact of sequence of returns risk. So that's why the bucket approach that we've written a lot about on Morningstar.com can make sense for a lot of people, where you set aside 1 to 2 years worth of portfolio withdrawals into cash, another 5 to 8 years in fixed income or moderated allocation funds, and then the remainder in stocks. And the benefit of that is I think it can be very helpful psychologically, because when you're making withdrawals in a down market, you can take them from the cash bucket and you don't have to be drawing down stocks when the stocks are going down.
Let's get into portfolio performance. Which asset classes have performed best and worse during recessions, and why?
Yeah, so normally stocks have had negative returns during most recessions, and the reason is if you have a slowdown in economic growth, that means for a lot of companies they will see revenue growth and earnings growth, operating income growth declining, and that is normally reflected in their stock prices. Bonds usually are a safer place to be in recessions, partly because they have stable cash flows. You know, when you buy a bond, you know exactly how much interest income you're going to get and what the value of the bond is going to be at maturity. So people often will buy bonds as a safe haven during recessions. And then another advantage of bonds during most recessions is that we often see the Federal Reserve moving to cut interest rates to stimulate the economy, which is positive for bond prices. So, that's the reason bonds are usually a safer place to be. And then obviously cash, it's not a growth asset over the long term, but, it does hold its value in down markets and recessions.
And gold can serve as a hedge against market volatility. What should investors think about before buying the precious metal or buying a gold fund?
Yeah, so we have seen a lot of people taking refuge in gold so far this year. As we're recording this on April 16th, I think it's up about 23% for the year to date. But a couple of things to keep in mind would be, one, gold itself, even though it's viewed as a safe haven, it is a volatile asset and actually almost as volatile as stocks. And another issue is that, given the fact that we've already had this big run up in gold, it's probably not the best time to be buying in right now. And then another issue to keep in mind is gold is really not a growth asset long term. So it does have a very long record of holding its value, over even century-long periods, but it doesn't really generate growth. So if you do want to buy gold, I would definitely keep your position size small relative to the rest of your portfolio.
There have been mixed results on whether large or small is better to own during an economic slowdown. What does history tell us?
Yeah, so from a size perspective, large companies typically will hold up better in a recession, and that's because a larger company usually has more diversified business lines, usually has a stronger balance sheet, so they're able to better hold up during periods of economic weakness. Whereas smaller cap companies, they may depend on a single line of business. They may have more debt on their balance sheets. So normally we see smaller companies tend to fall behind during recessionary periods.
And consumer defensive stocks showed resilience against other sectors during the tariff-induced sell-off. Did that hold true in past recessions?
Yes, we definitely see a pretty consistent pattern where consumer defensive stocks or consumer staples tend to hold up the best during most recessionary periods. And the reason for that is consumers normally don't change their buying habits that much during a recession. And for things that you need on a daily basis, like laundry detergent or paper towels, you're not going to cut back on those things just because the economy is down. Whereas things that are more discretionary, like clothing or cars, that would be probably the first place that people would look when they're trying to cut back on their spending.
And which sectors have historically taken the hardest hits?
Things like energy, financials, consumer cyclicals, infrastructure related things. Those are all things that tend to be more sensitive to downturns in the economy.
And market volatility is part of investing. We keep getting the reminders. Explain why it's important to create the game plan and then stick with it, Amy.
Yeah. So I think, market volatility can be very unsettling and can make you question about, should I be changing my portfolio? Should I be moving to cash? How can I avoid all of this uncertainty and volatility? But I think it's always helpful in these times to kind of go back to basics and remind yourself, what am I investing for? What are my long-term goals? Does my portfolio allocation make sense for my time horizon and my risk tolerance? So I think having a plan can really be an anchor against a lot of market uncertainty. And there's a famous quote from John Templeton that I like to go back to, which is the four most dangerous words in investing are, "It's different this time." And that goes to the idea that every market crisis does feel like it's different, and there's always something new that's causing the volatility and the uncertainty. But the problem is, if you start to panic or make dramatic changes to your portfolio in response to that uncertainty and volatility, that can really be counterproductive. So that's why it's helpful to not just have a plan, but stick with the plan.
Amy, thank you for your insights. They're always valuable, and for coming to the table today.
Thanks. It's great to be here.
That wraps up this week's episode. Thanks for watching and making this show part of your day. Subscribe to Morningstar's YouTube channel to see new videos about investment ideas, market trends, and analyst insights. Thanks to senior video producer Jake Van Kersen, associate multimedia editor Jessica Bevel, and digital communication specialist Kumudini Davala. I'm Ivana Hampton, lead multimedia editor Morningstar. Take care.